What up, everybody? Welcome back to the channel and welcome to the last video, the fifth video in the series of how to achieve great credit, which is the credit mix. Now, the credit mix is worth 10% of your credit score. And one last time, let's go ahead and throw the FICO pie on the screen again. You'll see we've already done credit payment history, which is 35%. Amounts owed or credit utilization, which comes in at 30%, 15% being length of credit history, 10% being pursuit of new credit or new inquiries. And now we're on to the last portion of the FICO pie, which is 10%, which is mix of credit. So what is the mix of credit 10% all about? Okay, the mix of credit is two different types. It's installment and revolving, two different types. Revolving credit is things like credit cards and lines of credit. Revolving credit has an indefinite time period. It does not have a contractual end date. On the other hand, installment credit does have a contractual end date. So installment credit is things like a car payment, a mortgage for a home, could be when you purchase things at like a furniture store. It's basically has a beginning date and an end date. And you need both of these types of credit in your credit profile to maximize your score. So what happens when you pay off, for instance, let's say you have a car loan. The car loan is say 6 years. Let's say you paid that car loan off. So you've had that reporting on your credit for 6 years. When you pay it off, you're like, woo, finally, I'm done with the car loan. But you are going to see a decrease in your score because now a 6-year account is gone from your credit report. Don't worry, those points will come back, but you will see a temporary decrease due to now that account that had pretty significant history being gone. So I had an issue myself the first time I tried to go for a line of credit. I had only had revolving credit coming out of bankruptcy for like the first 5.5 years. I didn't have any installment credit. I didn't have any car loans. I didn't have mortgages on my credit at that time. And I got denied because I basically had no installment credit. So another way for you to get installment credit, if you don't have car loans or mortgages, or even like say purchasing furniture, you could go get a personal loan through a bank or a credit union, and that would also service as an installment loan. Personal loans, I've seen them be as short as 12 months, as long as say 7-8 years. What you want to do is if you're just getting that personal loan to get the installment history, it's good to have 12 months of installment history with that personal loan for it to, really do some good for you as far as you trying to get additional credit and them looking at your credit profile for the last few years to see if you've had any installment credit. So the bottom line is, in order to get the most out of that 10% of your score, it's good to have some revolving credit history for sure, but you need to kind of cycle in some installment credit too. So let's say if you haven't had an installment loan in a couple years, it might be a good idea to maybe take out a small installment loan with a credit union. Sometimes they can be as low as $500, so you pay hardly no interest and you get the installment credit on your credit profile and then your history. And of course, this helps you to achieve a higher score. So that's it, guys. That is it for the 5 components of the FICO pie. Tried to give you all I could on it in a short period of time. So I hope that you found this credit series useful. So I'll be back soon as always, but until then, this class is officially dismissed.